Hello and welcome to the trade. Before we get to the charts, let's take a look at what's happening at macro level. US and Iran remaining at odds over Iran's uranium stockpile and controls over the Strait of Hormuz. With President Trump saying the US will eventually recover Iran's stockpile of highly enriched uranium, saying we will get it, we don't need it, we don't want it, we'll probably destroy it after we get it, but there's not going to let them have it, he said in a quote. And that the US strikes on Iran would resume if he does not get the right answers from the leadership, while Iran's Revolutionary Guards have warned that that would trigger retaliation beyond its region. Now in data, US manufacturing activity expanding in May by the most in 4 years as customers strive to get ahead of the mounting pressures ahead of the Iran war. The global flash May factory purchasing managers index from S&P rising 0.8% to remain in expansionary territory. The US 2-year Treasury yield was at 4.05%, the 10-year at 4.56%, and the Aussie 3-year government bond yields at around 4.6%, the 10-year slipping to 4.96%. And in the wake of the jump in the unemployment rate to 4.5% in April, markets now pricing in a 10% chance the RBA cash rate will be hiked by 25 basis points the next meeting in June. The US dollar up slightly, the Aussie trading at 71.4 US cents. Well, let's now turn to the charts and look at what is called the insanity line. That's what Carly Garner from DeCarley Trading has come up with.
Last couple of years, 2025, 2026 thus far have been really volatile. I mean, I think it's hard to argue against that. And some of these moves have really exceeded what I would call rational behavior. And so we've kind of plotted what we call insanity lines on the chart. And these insanity lines are basically pivot lines. But before we get into that, let's talk about the Warren Buffett indicator. This is a ratio, and it's basically the entire U.S. market cap. So he uses the Wilshire 5000, which is the value of all the stocks put together in the U.S., and then compares that to the GDP of the United States, the gross domestic product. Normally, this ratio is somewhere between 50 and 100%. We're currently we've kind of got off the rails in this ratio, and we're at about 230%. What that means is the market is over double the value of the US GDP. Now, there's a few reasons for this that can kind of explain some of this away. For example, the US is more global than it used to be. So we're now talking about a global GDP, not necessarily US GDP. So I'll give it a little bit of a pass for that. And also we have a lot of the Fed stimulus and money printing, money supply increases that explain some of this. But I still believe that we are in a state of euphoria or irrational exuberance, if you will. And I think there's a whole swath of younger investors and market participants that are convinced that they're smarter than Warren Buffett right at this particular point in time. But I think with the benefit of hindsight, 6 months or maybe even a year or two down the road, we'll look back and say the market might have had this wrong, and I think the market has it wrong.
All right, so given that then, Carly, let's go to the S&P 500 and see how it's playing out then. What are you seeing?
So this is the E-mini S&P 500 futures contract. And the reason I use that, well, first of all, I'm a futures broker, but also it's a 24-hour contract. So it gives you a really good idea of what's going on around the clock, not just during day sessions in the US or at some other area in the world. And what we see is there's a red line you can see towards the top of the chart. That's a trend line that started around the October 2023 lows. And that trend line has been very protective of price. It's reversed rallies each time that we've touched that trend line. And even more compelling is if you see the RSI at the bottom, that's the relative strength index. And that kind of shows us if the market's overbought or oversold. When the RSI gets above 75 on a weekly chart, it's not a sell signal by any means, but it's a condition to be aware of, because that's where the risks, the risk to the downside is probably a little heftier than the reward to the upside once we start getting an RSI into the 75 area. And you can see each time that we've touched that red line, prices have been rejected in a few cases pretty substantially. In the middle of that chart, you see a blue line. I call that the insanity line. In my opinion, and I know other people have different views, but in my opinion, a normally functioning market would probably trade below that line. That's a reasonable pivot line that should be, in my opinion, the top of the range, with the bottom of the range being somewhere in the high fives at this point. If that would be a kind of a civilized incline in a normal stock market. what we've gotten instead is something a little less civilized, and we're trading above that insanity line. My word, not anyone else's. But it's basically a pivot. We're bullish above, bearish below. So the point of this chart is to keep an eye on that level. It's about 6,800 right now. If the market starts trading again below 6,800, in my eyes, that kind of points towards normalization. In my opinion, normalization means the stock market coming back down to some sort of mean revision area, maybe in the low sixes, maybe in the high fives, but an area that's more comfortable and based on math, not emotions, which is what we're seeing now.
All right, Carly, well, let's pick up on what you're saying there with that insanity line and how that applies to the Nasdaq 100 futures and just how insane perhaps that is looking.
Yeah. And I should say, for those people that are long tech stocks, the insanity is a positive. For those that missed out, it's a negative. But in the Nasdaq, we have a very similar chart to the S&P, of course. But the Nasdaq, not surprisingly, is even more insane when it comes to valuations. We're really overstretched. I want you to keep an eye on the RSI at the bottom of this chart. It's above 75. In the Nasdaq, we've seen this. This is the fifth time we've seen it. The first four times ended in either a moderate correction or in a couple of cases, a pretty sizable correction. So this is a red flag to me. Time to take some risk off the table. If you've made some money on the way up, diversify and protect it because it might not be so friendly on going forward. That said, the insanity line falls at about 24,000 in my eyes. We probably should see prices get a little below 24,000 and maybe even quite a bit below it. The next uptrend line comes in around 19,000, just to give you an idea of how skewed prices are at these levels. Now, again, this has been a resilient bull market, probably the biggest and best bull market for most of us, during our lifetimes. So there's no rhyme or reason as to where it's going to end, and it doesn't have to end anytime soon. But we've noticed on the chart, every time we get up against these trend lines and the RSI is high, it's a time to pull in on risk, not swing for the fences.
All right, Carly, well, that's what we're seeing with equities. Let's see how this applies to commodities, beginning with crude oil. Now, of course, that is very much in focus given the crisis in the Middle East. Interested then to see where your insanity line is sitting for WTI.
Right. So it's not shocking to anybody. That's been a big year for the commodity markets. We've had tons of volatility. When the U.S. and the Iranian war broke out, the crude oil market rallied pretty sharply, almost immediately, from the high 60s into the 90s and even into the 100s. So my insanity line in this chart actually comes in at 92. It started much lower. When the war broke out, we broke above this insanity line. I think we're eventually going to fall below it, but again, it's going to take some thawing out and what's going on in the Middle East, and who knows? I'm not privy to that information. We'll just have to wait and see what happens. But if I'm just looking at the chart, any trade below 92 triggers normalization in my eyes. And normalization would mean we've got this kind of megaphone pattern going. You can see the red circles and the trend line at the top of the screen. And then there's a purple line with a kind of a downtrend line that's a shorter term trend that we're looking at. This is forming a megaphone pattern. I think if we get below 92, we're probably going to pretty quickly hit that purple line, which is going to be in the 70s, 72, 73, somewhere in that ballpark, depending on how quickly it does it. In this chart, in crude oil, the RSI is not nearly as overbought as it is in the stock market, but you can see that as the crude futures are making higher highs, the RSI is not following, and that's a telltale sign of momentum lacking. So if you've made some money in crude oil on the upside, good for you. We're in sell the mount rallies mode. Every time it gets up to that trend line, we're looking to sell rallies into it.
Well, finally then, let's take a look at gold. Now, Carly, gold has struggled since the outbreak of the conflict. So talk us through the chart and what you're seeing. So
it's my belief that somebody in the gold market had information that the public didn't have. The gold market rallied in reaction to the war well before bombs were falling. And so now we're getting kind of the aftermath of that, even though the war is still ongoing. With that said, in gold, I think a rational gold market probably would have topped out in the mid 4,000, sorry. You can see this is a horizontal insane line or insanity line right around 45.30. Again, above that's bullish. The bulls have a little bit of an edge, but once we get below that, we start going into normalizing prices. And in my eyes, we're looking at, there's a 200-week moving average, 200-day moving average that comes in at 4,400. And then below that, we're looking at like 3,850, 3,800. If we give way to the 45.30 area, I think that's exactly where we're going. But you know how gold is, it doesn't, no free lunches for anybody. We could easily see 4,800, 4,900, which is the trend line that you see at the top of the page. This is obviously a very volatile and very wide trading range. So the safest way, that's not the right word to use. It's not safe and gold shouldn't be used in the same sentence, but probably the best way to play this is if we do get into the high 4,000s, maybe buy a put spread or something with tame risk and try to see if you can catch a move on the way down. Because I do think eventually we do fall back into a more normal gold market, and that would mean much lower prices.
Carly Garner from DeCarley Trading, and that is the trade.